Welcome back to Liberty and Finance. We're always delighted to have this returning guest. Andy Schectman is the CEO of Miles Franklin Precious Metals. He joins us live for your live stream question today, this Tuesday, April 11th, 2023. Andy, thanks for coming back on Liberty and Finance.
Done again. It's good to see you, my man. How you been?
Well, we've been buried in cardboard boxes, but we can see the light at the end of the tunnel here. Although you see, I don't have my historical currency silver certificate posted yet, but it will be soon. And thank you for providing me that piece of history as well. That's one of the things that you've talked about several times is why 90% silver fascinates you, and pre-33 gold, because you're actually holding history in your hand, and it really connects you with our forebears and what they knew that we've forgotten, not just forgotten, what we've been carefully taught to forget about real money, sound money. Let's start there, if you would. We have several questions from viewers about 90%, one that's tongue in cheek, and then a serious one that follows up. One, Chris P says, ask Andy, where is all the 90%? Did he keep it for himself? And they said, on a serious note, Thomas Toop said, ask Andy how tight the 90% supplies are.
Stupid tight. Really, really, really tight. The last several weeks have been as chaotic as anything I've ever seen in my career. I mean, it's just been complete and total madness, and there's been a high premium on those types of items, on 1/10 ounce gold eagles, on junk silver. There are a lot of people who are taking this environment to the worst possible level, and that's without any prodding or without any input from me. When I talk to people, there are a lot of people believe that the bottom could fall out for a period of time. When you talk about junk silver, this is something that hasn't been made for 60 years or whatnot, and so finding it is hard enough as it is. They say there's no bull market like a gold bull market or a metals bull market for one reason. It's the only market that appeals to your concern. And so no one wants to go back into fiat. No one wants to send their junk silver back and trade it for something else. This is what they've been waiting for. This is what they see. They see all of the things that have concerned them materializing at once. And that's why they say there's no bull market like a metals bull market, because the higher the price goes, the more difficult the product gets, the crazier the world becomes, only seeks to strengthen the motivation that was used or employed to go this direction in the first place. And I think that's pretty much it. When you look at equity bull markets, the idea is to take your winnings and play with the house's money and reposition it somewhere else into another asset or another security or whatever it may be. It's not the case with this, and it's a limited supply. It's a finite supply. It fits hand in glove with what I've been saying for quite some time as the little boy who cries wolf, that the market will define itself by an inability to source product. That is what junk silver is. It's a finite supply. And when it's gone, it's gone. Now, you could draw the same analogy to the United States Mint and the other 5 mints around the world. When they run out of product, it's game over. So, this is where my thought process has come from. It's always gone to the point that there's such a small interest in metals in this market that when the mainstream wakes up, as they are right now, not only because they're terrified of what they're seeing here inside the country with the brain dead monetary policy or the ridiculous decisions that the Treasury has made regarding who lives and who dies in the banking system, that's certainly part of it, no question. But also the awakening of the states, the states that, like Missouri and Tennessee, get out of here. Sorry. Missouri and Idaho and Wyoming and Texas and Alaska and all of these states that are now issuing or allowing gold and silver to be part of state treasuries, and even taking it further and using them for all debts, public and private. The state of Texas now talking about issuing a digital gold-backed alternative. And so this is awakening the constituents of these states. This is awakening the mainstream little by little by little at a time when people are really afraid. So, junk silver is the ultimate vehicle for barter, for fear premium. And I think that's why you're not seeing it. And quite frankly, I don't expect much of it to come flowing out into the system. Maybe if silver goes much, much higher, but it's been a problem to get now for the better part of the last 3 years. We've had times where we get some when someone sells some, or we're able to find it, but in general, it's really tough to find.
It's one of the products where I have to catch myself and discipline myself as a broker when people call up and say, Dunnigan, does Miles Franklin have any 90% constitutional silver to sell? I'm stopping myself. I can't answer the question until I check our live inventory, because about 50% of the time I'm wrong when I think we have it, because there are a few species that we've been able to keep better in stock than others, because they're not in that value cone there where most of the circulated dimes and quarters are, where most people like to start. But once you get past that, it's all bets are off in terms of just answering the question blindly. I've got to check the inventory before I answer the question. Something else you touched on was from our good friend David Smith, God rest his soul, talked to us from the Morgan Report several times about anyone who talks about buying physical precious metals with the idea of flipping them for a profit doesn't understand what they're dealing with. They don't understand. And it reminds me maybe of a line from the Jurassic Park where Ian Malcolm says, it's like somebody who playing with his dad's gun or something. It's like, if you think it's just something to flip, you don't understand what it is.
Well, not only that, the people who own the pre-65 silver are the real diehards that understand really what precious metals represent. They're the people who buy it for the right reasons. And I'm not saying bartering is the right reason. I'm just simply saying that it lacks the appeal of the 1 ounce pretty coins that is more intriguing to people who are buying this stuff now. It serves a purpose that someone who's really committed to understanding what is wrong with the system and what gold and silver represent. They're the ones that have been stockpiling it for a very, very long time. And I remember doing an interview with you back in 2020, and we offered it as a special that was like under $2 an ounce or somewhere in that neighborhood over melt value. I haven't looked lately, but I would think it's $8 or $9 an ounce over the price of silver. It's that hard to come by. And
it's higher than that. Yeah.
Yeah. So, that's really the issue, is that, I guess, call it what it is. These people who are asking about it are somewhat late to the party, unfortunately. So the selection is not as extensive as we would like it to be. I know we have some half dollars, and you can buy some silver dollars, but the pre-65 dimes and quarters is it's really just becoming a situation of there not being much of any availability within the industry.
Yeah, that's one of those symptoms where the premiums have really spiked in the last 2 weeks. We were down in the $8 to $9 range about 2 weeks ago. Now we're up in the $12.25 to $14 and up in terms of what species you're talking about. So, and that's if we even have it. That's another thing, question that I keep getting asked over and over by people is, are we going to see a pullback, or are we just going to have to take advantage of any little dip that might come our way on the climb out? We just interviewed Michael Oliver yesterday, and he said,
one of my favorites.
Yep. And the thing about Michael Oliver is he's looking at momentum structural analysis. So he's always looking at forward looking indicators. He says, by the time you get like all-time high price breakouts and stuff like that, that's a reverse, that's a rear facing indicator. It's not going to tell you, you're way past your optimal entry point at that point. And he's talked about that all of the signals, all of the lights have turned green for silver in particular, but also for gold. So I have to couch my answer again when people ask me, Dunnigan, are we going to see another pullback? Are we waiting for a value entry point or whatever? We all wonder that in many areas of life. When you're trying to acquire something that's important, you always want to get it at a great value, but it's not possible to answer that question definitively, other than as Gregory Manarino often says, markets don't go up in a straight line. There's a jaggedy line in whichever direction they're going, but you never know if there's going to be a sharp pullback from what level that might occur, and will it even get back to the point? And then there's the point about availability. So that's another thing. Regardless of what the spot price goes to, will there be anything to be had? In the case of circulated dimes and quarters, about 50% of the time these days, there's not. And if we could zoom out then maybe to more of a macro picture on this same topic about availability, we have a question from Fazdal asking about what does Andy see the future of the rest of the year looking like on the major exchanges as far as availability of metals on the major exchanges?
I think it's all dependent upon what happens on a macro scale. I mean, we're seeing so many things happen. You know, when you and I started talking about the BRICS nations, and I, you know, I was screaming for 3 years about what's happening globally, and no one really talked about it but me. And I've seen it very clearly for 3 years what is coming. And I called it a linear progression of events forever when you and I would talk, and a progression of events that kept happening little by little, slowly. And now these events are accelerating dramatically. When you see our allies like Mexico quietly leave the room and formally apply to BRICS, it's bad enough that Saudi Arabia has signed a protection agreement with Russia, has formally joined BRICS, has told the folks at Davos that they're open to taking other currencies for oil, but now they've joined the Shanghai Cooperation Organization as a dialogue partner. That is the first step of being a full member. The Shanghai Cooperation Organization is a military group as well as an economic group. You are in essence setting the table to be protected by Russia and by China. You are setting the stage for them to flip the switch. You look at our allies like Macron, who from France, and if you remember, you know, in 2022, France was one of the original allies that stood by us in our sanctioning of Russia. And now they're quietly leaving the room. They did a very large liquid natural gas trade with the United Arab Emirates and China a week or two ago, all of it to settle in the yuan. But now they just did a very large deal. Macron was in China, and they signed a 51-point declaration, joint declaration from that ranged, as the article said, from military or from 5G to military engagement. What? France is signing a deal with China all the way up through military engagement. It is beginning to seem as though even our allies are beginning to choose sides, and this is a frightening thing. I think it is speeding up. You have Brazil, who just the second largest exporter of corn in the world, said all of their trade with China will be in yuan. So these things are speeding up exceedingly. And whether you look at the problems that happen outside the shore with what appears to be a growing concern and speed at which the BRICS nations are forming and are building this union opposite the dollar, or what's happening inside the country with really a fuse being lit underneath the commercial banks for under the regional banks for $1 trillion over has been pulled out of the regional banks in the last week, going into the handful of commercial banks that are paying a higher rate in the money market accounts than you're able to get in a CD at a bank, and absolving yourself of the inherent risk that Janet Yellen said she would pick and choose, along with the FOMC, the FDIC, herself, and the president, as to which banks live and which banks die. You are witnessing the destruction of the regional banks. There's 5,000 of them. They represent 70% of all the small business loans. They hold the majority of all of the commercial real estate loans, not the big skyscrapers, but everything else, which is dying. And they are blowing things up. On the inside, we are blowing things up already on the outside, and you can see the reaction, counter reaction with all of the countries aligning and forming sides and alliances. And if anyone's waiting for a pullback at this point, I mean, wake up. With all due respect, wake the hell up. Right? I say that with all respect. I mean, you've lost that ability to cost average, which every single time someone came to me and said, what should I do? Should I spend it all now? I'd always say, no, cost average. And I meant it, because it is the only way to smooth out the uncertainty. Even in my mind, I always thought, you know, geez, one of these days the wolf comes, said the little boy. And, but if you had cost average all of these years, you would have ended up a winner. But I do really believe that, honestly, and with sadness, that we are getting to that point where it's very close to breaking, whether it be inside or whether it be outside. We're very close. And I think the time for waiting for a pullback is foolhardy, because what we've seen over the past 3 weeks, and again, we've added 12,000 clients in 30 days. I mean, what? That's years worth of clients. This is an expansion into the mainstream that we've talked about, albeit very, very slightly. What happens when another regional bank or a series of them fail? I was just speaking at Robert Kiyosaki's conference in Arizona, and Jim Rickards talked and said, you have not seen the end of the bank failures. And that's by design as well, I believe. And what happens when another 1 or 2 or 3 banks fail? What happens when something happens more significantly with the petrodollar, or with what's happening with Saudi Arabia or the BRICS nations? I think it's on a razor's edge, because there will come a point when the mainstream wakes up with great fear and runs to this industry, and it will be completely gone. That's what I see in my mind's eye. I don't know what the trigger is or when it happens, but I guess I would simply say this. If you don't own any metal, you wouldn't go and buy a gun to protect your family and then wait for the bullets to go on sale. You would buy the bullets, and then, as often as you can, and in particular on the pullback, you would add to your position. And the same thing is true here. Get your darn core position in hand. Stop waiting for this pullback. And when it does pull back, make some additions to it. But honestly, I have never been more convinced and more concerned that we are getting really close to that moment where we wake up on a Monday morning, just like we did a few weeks ago, to see the chaos in the regional banking system. We'll see it with the dollar or with the price of metals. And it's going to go a whole heck of a lot higher than anyone thinks possible, and faster than anyone thinks possible. And that reaction will trigger a deluge of purchasing into this industry that in 1 or 2 days will wipe out the entire system. It's that small of an industry. It's that fragile of an ecosystem. So yeah, I think waiting for a pullback would be about the worst thing you could possibly do, unless you are adding to a current position. Then that's always good advice.
We've got I meant to ask you this back when we were talking about the availability and premiums on 90% constitutional junk silver. Jake's Custom Part asked a similar question about American Silver Eagles. Question for Andy, his opinion on the future of U.S. Silver Eagles inventory and premiums.
Yeah, I don't get it. I mean, I just don't get it. We're back up to almost $17 over spot right now. I mean, it's just insanity. It truly is. It makes zero sense to me. Now, the conspiratorialist in me would say that, well, is the U.S. government stockpiling silver? Do they realize the sticky wicket that they find themselves in a world that needs silver and is watching it being bled dry from the exchanges rapidly? Maybe that's the case, because Janet Yellen, Secretary of Treasury, got on the website of the Mint and said, we've ramped up production. And I say, you're lying, Janet. That's not true, because production ramp up would then deem that she makes close to 50 million Silver Eagles, which they've done before, not the 14 or 15 they made last year. And when I see premiums on the cheapest online companies in the world at $17 over spot if you buy 1,500 coins. That is not ramping up production. When I can sell people Britannias or Krugerrands or Philharmonics or Kangaroos at under $5 an ounce, and that represents a $12 discount to the American Eagle, something is very, very wrong. And look, it's pretty much been that way since March of 2020. There's been ups and downs, but whatever they're doing at the US Mint as it pertains to silver, it's really important to them because they have been woeful in their release, in their production, in their information, and the premiums haven't gone down. It's the darndest thing ever. It truly is. And yet the only gold that I've been buying personally for myself over the past year has been gold eagles and gold buffaloes. They have not reacted the way the silver coins have, although they are higher than normal. Something's going on at the mint with the silver coins, and I can't quite figure it out. But you know, it just, to me, I have a very hard time, as much as I love the US Mint, as much as I love the Silver Eagle, as much as the mint has meant to me in my career. I can't recommend in good conscience that people buy them, and I have no idea what's going on there.
This is flipping it around to the dealer side. Billy Yoder asked a question that I think might have buried in it some misconceptions that we've addressed in the past, but it's worth addressing again. Question: if the price of silver goes above $50 an ounce, do people realize their local metals dealers will probably turn you away when you try to sell it because they can't afford buying at that level?
I think that's actually not such a stupid comment. I think that's a pretty smart comment. The difference between, and stupid's the wrong word. I don't know why I said that. It's just, it's a smart comment. It's not foolish. The difference between a coin shop usually and a dealer like us is the ability to hedge. And that's why we have relationships with a lot of the small dealers around the country, where we will take their inventory. They'll call us, they'll say, the person at the counter, 1 second, they'll go and call us and say, hey, I have someone here that wants to sell 5,000 Silver Eagles, and we'll buy it. Because it's difficult to buy things at super high prices if you don't have the ability to hedge. And maybe they don't have the deep pocketbooks as well. So that's a possibility, I guess. It depends what kind of quantity you're talking about. When you're dealing on a local level, usually you're not bringing in huge, massive quantities. So I don't know that they'll turn you away, but the real issue is, do they have the ability to hedge the risk? If you buy silver at $50 an ounce, forget what the premium is. If you're able to hedge your position, then you don't care what happens to the price. Because if the price goes down and you've hedged your position appropriately, what you've hedged goes up commensurate with what is going down. And so you remain market neutral. The problem is it's fairly sophisticated, and most of these small coin shops don't do it. So it could happen. You could see them turn you away or point you in the direction of a larger dealer. But nonetheless, it's still worthy of making a relationship with these folks and, you know, feeling them out before that happens. But it's not outside the realm of possibility.
Yeah, I think one of the reasons I was concerned about a possible misconception there is not as though dealers are sitting on a hoard of cash that they're having to make a one-way market. It's not one way. It's if they're going to buy them at the current market price, they're going to sell them, and the spread in between the two is how they make their business. There's people who are interested in buying as well at that time. But you're right. There's the hot potato problem, where when you get into a very peaky and volatile market, it can be a danger for anyone who's going to be buying or selling something to get caught in or get caught out. One way or the other, you can get burned if you don't have a way of hedging and protecting yourself.
Yeah, for sure. No question about it. And that's what differentiates a major retailer from a small coin shop. Both have their place in the ecosystem, but to do large orders and to hold a large inventory or to buy expensive items, you have to be able to mitigate your risk, or with all good intentions goes against you, you're out of business.
Now, you lived through the the peaky days of the 1980s and the peaky days of the 2011s, and this question may be informed by those experiences that you lived through. Chris1234 says, seeing many vacant stores, when you see them becoming We Buy Gold and silver stores, then you know the time is very near. I definitely remember that when every little abandoned storefront, every little kiosk in the mall was like, we buy gold, we buy gold, we buy gold. How does that, if in any way, materially change this ecosystem when those sprout up? What's it a sign of? And does it change the supply and demand dynamics?
I mean, I guess it's a sign of desperation for people looking to raise capital in what would be a slowdown, a recession. And when you see the inverted yield curve that is now starting to trend up, when you look at a graph of the inverted yield curve over the last few times we've had inverted yield curves, the recession that follows it, and it's a very predictable indicator, always comes almost every time once the curve gets up past inverted, and then comes the recession. And I think that we've had a very, very strongly inverted yield curve for a long time that is now trending up, which would indicate we're getting very close to that recession that arguably we're already in. When businesses start to slow down, shops start to disappear, and people are in need of cash. And that's when you see those types of shops pop up. In general, most of those shops, they really are a disservice to the consumer, because they are paying typically 50 or 60% of that melt value instead of paying 95 or 98 or 99% as a more reputable one would. I guess it's just a sign more than anything of, I guess, a slowdown in the economy, a recession, and people's need for liquidity. I would tell people they would do far better than selling their gold to one of these kiosks, to talking to a company like ours or a more reputable refinery that will give them a better price, rather than the convenience of a pop-up kiosk at a mall where you're lucky to get 50 cents on the dollar.
Yeah, if you think about it, it just makes, I remember being in the mall, walking up to one of those kiosks. This was just after 2011. I was interested in gold, that sort of, and I was asking what they were buying it back at, and they couldn't answer a question straight. First of all, the person who was working in the shop was probably selling perfumes or something the week before that. They know nothing about it. They said, well, if it's 14 karat, and then we have this little chart, and you look up, we put on the scale, and then we calculate it, and I did the math on the fly while they were talking to me about that, and it really was below 50%. It was just terrible. It makes you think about when you go and buy a soft drink at the airport or someplace where you're basically, if it's that convenient and you're that much of a captive and they're bringing it that close to you, it's probably going to not be a fair deal. You know, fair prices happen between fully informed and unconstrained buyer and seller. And boy, there's lack of information there, and there's the constraint of people taking that proximity to their local kiosk or storefront or whatever, rather than seeking out a fair price. If you have any further comments on that, otherwise I got one follow-up question that kind of dovetails into that.
Yeah, you know, I'll answer that too. And as I've been thinking, sitting here, I was thinking about the question you asked me earlier before we got online. And I think I'm up to the challenge to answering it now that I've kind of let it ruminate in my brain. So if you want to ask me that one after, also, I'm happy to answer it. But what was your follow-up question here?
Well, the follow-up question is, I continue to hear horror stories from clients who are approaching Miles Franklin for the first time, and then they mention, I've previously bought from, and they mention one of these big name places that I'm not going to bring up, but it's one of the names that I'm learning to kind of try to suppress my shudder every time I hear those names. And one of the things they say is, yeah, I put my whole IRA or my whole 401k into that, and I got all proof sets, or I got all double strike gift sets or whatever. It was just this, and the multiple times spot price, that sort of thing. Any new added awarenesses that people should, at least having heard us today, some people are new, they may not have connected in for those previous discussions, that people should be wary of when they're talking to dealers that have big shiny glitzy ads and big fancy spokespeople, and they talk about, we'll take good care of you and we'll handle you, get you in your physical IRA and all that sort of thing. And what red flags you need to watch out for.
There's one out there that's the worst of them all. And honestly, if I could say it, if I didn't feel so strongly against doing things like this publicly, I'd love to tell everyone just what a piece of crap they really are. And they're a big company, and they are as criminal as anything I've ever seen. And their tactic that they use now are they sell these coins that they try and call Liberty coins, Liberty Gold and Liberty Silver, the connotation being that they're US Mint made. They look very much like they were made by the US Mint. Maybe they have a Statue of Liberty or Lady Liberty, but they're not US. They're made, they're rounds that they're having made, and they're selling them at such ridiculous premiums. It's just absolute, it's just criminal as far as I'm concerned. And you know, these people who are buying them, I tell them to go look at your statement that you get from you know, the custodian, and they look at it and they can't believe the haircut they've taken. It's really becoming a problem. The biggest problem are the companies that solely focus on IRAs. Any precious metals company that gives 90% of its attention to IRAs, you have to call around before you pull the trigger and seek a second opinion on price. I've seen such horrific things that I just don't understand how people can do that. Everyone deserves to make a fair living. Everyone deserves to, you know, you work hard, you're supposed to be able to put food on the table and take care of your family. But these companies are so awful. They're so diabolical. They're so criminal. They're so disingenuous. It's just absolutely horrendous to me. I wish I could say who they are. I don't need to be slapped with a lawsuit for slander, but it's not slanderous when it's the truth. You know who I'm talking about.
Yeah, there are several.
I would just simply say this to everyone out there. If you have already made a purchase with a company specifically focusing on IRAs, give us a call. Let us tell us what you got and let us see if we can help in any way. But those are the ones, and if you think about it, they do it because most people put it in their IRA and they forget about it and they don't even look at it. But it's just gotten to the point where I wish there was more that I could do, because it's really putting a black eye on this industry, as far as I'm concerned.
Yeah, that's another thing that's tough, is when people have become unfamiliar with real money and sound money that all of our grandparents and great-grandparents and everyone who came before them completely understood. And so getting back into it, even a nephew of mine who has a position of significant responsibility in a very much a freedom-loving state that has passed some of these legal tender laws with precious metals, still the comment that he made when he made a purchase through me from Miles Franklin was, "Whew, scary." And it's like, we're taught to feel like we're taking a risk by doing what is actually the most safe and secure and conservative thing to do. So you add to that misconception the actual bad practices that some disreputable dealers maintain. It's understandable why people feel cautious, and it doesn't help when they go to get their funds sent from their bank, and the bank gives them a third degree sometimes about what are you going to do with this, where are you going to store it, how do you know this dealer is reputable. There's some valid reason for some of those questions, because not all dealers are reputable. Right. So there's some of that diligence is justified. So the question that had been asked by a viewer, I'm going to get back to it here, was, and this is from nickname GY, who says, when treasuries are dumped overseas, by what mechanism do they return here? Federal Reserve has to buy them to keep them off the market because, one, nobody else wants them and it's bad for business, and two, they are the buyer of last resort. If I'm wrong, how does it return? So we've always
a lot of what I've been talking about are dollars being dumped overseas, but treasuries as well too. So yeah, I mean, the treasuries are sold, interest rates rise, and when they're sold, yeah, the Federal Reserve presumably will be the ones that ultimately purchase them. But even if it's another bank that is buying them, that's irrelevant. It's the dumping of the treasuries onto the market, the selling of them, regardless of who's buying them, creates interest rates to rise. And so I've been talking more about dollars being dumped, less about treasuries being dumped. Yeah, there are 2 trillion in treasuries between Japan and China, sure. When they dump them, when they sell them, they are selling them to another entity, to another bank, or to the Federal Reserve. And if nobody buys them, the rates just continue to rise on them. They just become a dead weight as the bond value continues to drop and drop and drop and drop. No one's buying them. By extension, interest rates have to go up and up and up and up. So eventually someone buys them, or I guess the Fed steps in and buys them as the purchaser of last resort. But whether you're talking dollars or you're talking treasuries, when they are sold onto the marketplace, if there are no buyers, well, the dollar just continues to fall in value. And that creates massive inflation, and interest rates ought to spike as a result of that. If the bonds are dumped and there's no one there to buy them, then the rates will just continue to rise as the bonds will continue to fall in value. You would think at some point someone will buy them as rates continue to rise, or the bond market just falls apart. So either they're purchased or the bond market blows up, that there is no market for it at that point. And that's why as the bonds fall or are sold, rates have to rise to try and attract those buyers. At some point, buyers will step in, or the Fed steps in and pays a rate that they want to masquerade as reality. But that's really the issue that we are seeing, I think, ultimately, is with the dumping of dollars and treasuries globally. Whoever buys them, and if no one wants to buy them, then the value of both collapse. And it just becomes, worthless paper, like Weimar Republic in the case of the dollars, or interest rates that spike to the moon because no one is buying the treasuries become worthless, which begets more selling, which begets more fear and more chaos, and the treasuries are dumped onto the market. And if no one buys them, the treasuries just absolutely collapse, and by extension, rates go higher, and it's just a self-fulfilling prophecy. I don't know at what point does the Federal Reserve step in to mop those up. I don't know what the actual process would entail when China sells treasuries, who they are actually selling them to, who is buying them. I would guess it would be the commercial banks in the United States, or actually back to the Federal Reserve. And if no one takes them, they continue to fall. Rates continue to rise, and the whole thing blows up in a much more expedient fashion. But I think that's ultimately what's going to happen. When you talk about Japan talking about joining the BRICS nations, well, they hold $1 trillion in our treasuries. At what point do they sell them? You're seeing a tremendous amount of these bonds being sold already by China and other countries, and not purchasing them. So I don't know exactly how it would play out if they all get dumped at once. Who would the buyers be? But I think dumping that kind of quantity onto the market, either the Federal Reserve would have to step in to buy them, or rates will go parabolic in and of themselves. So it's either the Fed or one of the member banks jumps in and buys them at a higher rate, obviously, or the whole thing just explodes. And that's really, I think, the fear here, is that there's always been a market for what is considered the safest investment in the world, US Treasuries. Could it ever happen to where the US Treasury really isn't demanded? I mean, look, if you see the dollars get dumped globally and no one buys them, and it creates a massive inflationary tsunami, you can't have rates at 4 or 5% on a 10-year Treasury when inflation is running many times that, or no one buys them. So either, the Fed comes in and papers it over and buys them, or rates just go parabolic and the whole system collapses. It's a very scary thought to think about, all of these bonds being dumped at once. But I would think that the Fed probably has to step in and buy it to avoid rates going to the moon.
Yeah, our dear friend Rob Kirby, God rest his soul, always talked about, he said, why is it that the United States has never had a failed bond auction? And he talked about these hidden pools dark pools of money, the exchange stabilization fund, et cetera.
Islands or whatever, yeah.
And yeah, blaming it on Ireland or Cayman Islands or whatever. It's like, really?
That's what
So,
they have to do. If they
yeah.
don't do that, then the bonds seek a floor. And the harder they fall, the higher the rates go, which is just exactly what they don't want. And that's why they're inversely correlated. If no one wants the bonds, then the only way to attract it is by rates rising higher and higher and higher. And this is the way it should be, right? This is the market saying, what's the rate that we're willing to pay for holding your debt? And if there are no buyers, that means that rate's a whole hell of a lot higher than they pretend it to be. So this is really the biggest problem, Dunnigan, is that the distortions and illusions that have been created through suppression of interest rates have put us in a very bad position where you're so far down the rabbit hole that you've created such massive distortions in asset prices and misallocations of capital and resources, and where price discovery is really very difficult. You know, homes aren't supposed to double or triple in a year or two, and 401ks aren't supposed to double in a year or two. And all of that has been accomplished by decades of suppressed interest rates and easy money. And at some point, Mother Nature gets her pound of flesh. At some point, you have to deal with these distortions, and certainly the bond market is a very big distortion because, you know, interest rates ought to be a whole hell of a lot higher when you factor in the inflation, when you factor in the risk. The bond market is controlled both the front end and the back end, and that's the problem. Instead of the market controlling the rates, it's being controlled by the bankers who are trying to keep everything held together. And you know, it's interesting, the 10 and 30-year rates are you know, lower than the 2 and the 10. That's the inversion, and that's the bond traders' way of saying that the Fed's going to come in and lower rates again. But ask yourself, if they do that, I mean, they've already erased 3/4 of all the quantitative tightening they've done over the last 8 months. They've erased that in 3 weeks. $400 billion added to their balance sheet again. At what point does the rest of the world just say, enough already? And maybe this is why you're seeing all of these countries join together, and why you're seeing all of these countries, you know, that this deal that was just done between Brazil and China for yuan is being also done primarily on the CIPS system, the cross interbank payment system. It usurps SWIFT. All of these countries are setting up pathways and relationships to circumvent these types of problems. The West and their ability to sanction, and also I would argue maybe even the fallout. You will see more and more bonds be sold before it becomes very obvious. And at some point, when the world is like, well, why would we sell them oil or anything that's made in China or any hard commodity for a currency that they have proven they will choose inflation over austerity. They can't raise rates high enough. We can't. We raised rates just high enough and nearly blew up the global banking system. You know, everyone talks about Signature Bank and Silicon Valley Bank and Credit Suisse and the bank that started it all, Silvergate. No one's talking about the $20 billion that was given to the Swiss Bank Corp, the second largest bank in the world, by the Fed. The systemic nature of it all is absolutely horrific. What happens if it all blows up? And I think we're getting to that point where the world realizes that the risk in holding treasuries and US dollars is not commensurate with the return. And that is because the return has been manipulated for a very, very long time. And when you're buying a 10-year treasury as it is right now, yielding under 5% with inflation higher than that, you're going backwards. And inflation is a lie. And the world is catching on to the way that we massage the numbers and manipulate the markets. And that's why Zoltan Pozsar calls this new Bretton Woods 3 environment, as he calls it, one that will be dominated not only by commodities, but also by transparency. We have a very opaque system over here, and the transparency of blockchain and of commodities pegged to a system, I think that a blockchain system is what's going to spring up as a result of all of the mistrust and of all of the problems that have been created through suppression of interest rates. It's less suppression of gold and other things. It's suppression of interest rates that have created all of these problems, the distortions, the illusions, the markets that are overvalued tremendously, and the risk that comes when rates find equilibrium, if it's possible, with asset prices. And this is all connected together, but I do believe that the world is moving away from this inherent risk, not only the hegemony and the hypocrisy and the sanctioning and the bullying and the bombing and all of these things, but as much as that is part of the equation, it's also the illusion of the value of the treasuries and of the dollar that is being inflated and being suppressed.
I wanted to pull together, speaking of bringing things together, I want to pull together two themes that you've mentioned over this entire interview. One of them is about markets breaking. You've talked about the potential for the U.S. Bond market to break if, in fact, we have a tsunami of sold treasuries from foreign holders that there's no one standing to buy them. If there's no bid, that could break the bond market. At the same time, you've talked about an existential threat to those who have not obtained what they must obtain, which is, physical safety. And those two thoughts together, breaking markets and existential threats. Question from Dan Spain says, Andy, if the COMEX shuts down, breaking market, do you see a possibility of dealers such as yourself stepping up and becoming, quote, the market, short of an alternative electronic market?
I love Dan. How you doing, Dan? I appreciate you, brother, very much. Say that question one more time. I was too enamored with the fact that I talked to Dan. I know who he is. So say that one more time.
Well, I lost it on the screen here, but I'll try to restate it best I can. If the COMEX were to shut down, do you see a possibility of dealers such as Miles Franklin, or perhaps in collaboration, providing, quote, the market if the COMEX won't do it?
Something will arise, but it won't be from companies like ours. Something will arise. Maybe it would be a co-op where everyone pools together. I don't know, but I mean, what the COMEX represents on a broader scale in many cases is the supply that is used to make the bars and the coins. But more than that, it's the ability to hedge inventory. If you can't hedge inventory, you can't have a big inventory. And then it just becomes, you pay up front and we make the purchase for you. And when we get the product, we send it to you. The COMEX was originally designed for farmers or any entity that's dealing in commodities to offset risk, to hedge their exposure. That's what it means to me. And yes, it would be incredibly disruptive. It would be incredibly disruptive. And you could argue that we're not too far away from that moment. I mean, I never really thought it would happen, really, but I mean, look, there's only 39,000 ounces in silver registered category right now, and India imported 304 million last year. Even if you take all the 288 million ounces of silver, of which the majority of it is not for sale, that's a pittance. And they're trading many, many times that every day. It's a scam, it's a farce. And one of these days, if I had to guess, in conjunction with what's happening globally, the price setting mechanism of the world will move to Moscow, to Shanghai, to Dubai, wherever it is, it's going to move away from the West. When the finance ministers in Russia talked about opening this new exchange in Moscow, I mean, the rhetoric was something to the extent this is being done to fight back against the manipulation on the Western metals markets. And you could argue that there will come a moment where the West loses its ability or its credibility to be the price setting mechanism of the world. And not only would that come at the expense of the dollar, when the dollar is no longer the reserve currency, so metals and commodities are not valued in dollars, but also the commodity exchange will no longer have that relevance. Now, what does that mean to our ability to hedge? What does that mean to the COMEX? Does it disappear? Does it reappear in a different form? I don't know, but I could see it happening. simply speaking, yes, it would be a very disruptive force if companies like mine could not hedge 65 or 70 million dollars worth of inventory. If you can't hedge it, you can't hold that. You go out of business in one day if it goes against you in a very severe manner.
I had one more question highlighted here, and man, they're coming in so fast it flew off screen. I got to go back and try to find it. So I will. Oh, here we go. Alan Ritter says, can we talk about the laugh the president of Kenya got with that get out of the dollar joke? It's like everybody else is in on the joke, but the USA.
Yeah, so the first, the president of Kenya strikes a deal with the UAE and Saudi Arabia to buy oil in Kenyan shillings. And I often talk about a game of Jenga. For those of you who play Jenga, the big tower of blocks, and you pull one out at a time, and he or she who pulls out the last piece before the tower falls loses. In and of itself, Kenya, which is, you know, a country that wouldn't even register in the mainstream news, and of course none of this makes the mainstream news, saying that they're no longer going to use dollars, another piece of the Jenga out to buy oil. When he says to his countrymen and women, hey, I have advice for those of you holding dollars, you better do what you need to do, or you're going to, those of you holding dollars, you need to do what you need to do, or you will experience losses, he says, because in a few weeks, this market will be very different. Now, what does that mean? Is it 2 weeks? Is it 5 weeks? Is it a few months? Is there going to be something very different? Yeah, absolutely there is. If you don't notice this massive move away from the dollar in settlement, and this massive move away from the dollar, not only by countries like Kenya, but our own allies like Macron, they're leaving the room. They're doing the Irish goodbye. You turn around, where'd they go? And they're gone. Well, that's France, who's one of our biggest allies, and Mexico, Saudi Arabia, and Egypt, and Turkey. These are all countries that we've had great relationships with, and they're choosing sides. And that's the frightening thing about it. And when you factor in, hey, could we really lose New Zealand and Australia and Japan to the BRICS nations? Where there's smoke, there's fire, there's rumors about it. But at some point, you will have to choose sides. And when France, it's bad enough they do a massive liquid natural gas deal in yuan. It's even worse when they strike a 51-point deal with the Chinese, ranging from 5G to military engagement. Mm-hmm. I want to read something to you. I got to read this to you, okay? Let me just find it. So a couple of things. This is worth the time. It'll take a second. So the article that I read this in was in Politico. And here's a couple of the things that he said, and then I want to read to you the last piece. Will blow your mind. These are actual quotes that Macron said. He said, Europe must reduce its dependency on the United States and avoid getting dragged into a confrontation between China and the US over Taiwan, French President Emmanuel Macron said in the interview on his plane back from a 3-day visit to China. He said, Europeans cannot resolve the crisis in the Ukraine. How can we credibly say on Taiwan, watch out, if you do something wrong, we will be there. If you really want to increase tensions, that's the way to do it. Russia, China, Iran, and other countries have been hit by US sanctions in recent years that are based on denying access to the dollar-denominated global financial system. He says, some in Europe have complained about weaponization of the dollar by Washington, which forces European companies to give up business and cut ties with third countries or face crippling secondary sanctions. So he's saying, there are people upset about the weaponizing of the dollar, not just with the countries, but also with the companies and the banks. There was a French bank that was sanctioned a few $1 billion for trading with Iran. He's talking about we can't do anything in the Ukraine, so why should we think we can do anything in Taiwan? But here's the crazy part. He says, Politico's disclosure at the end of the Macron bombshell this weekend even indicates that the French president may have had even harsher words for the US, but they may have been cut out from the story. Listen to this. As is common in France and many other European countries, The French president's office, known as Elise Palace, I know I'm saying that wrong, insisted on checking and proofreading all the president's quotes to be published in this article as a condition of granting the interview. This violates Politico's editorial standards and policy, but we agreed to the terms in order to speak directly with the French president. Politico insisted that it cannot deceive its readers and would not publish anything the president did not say. The quotes in this article were all actually said by the president, but some parts of the interview in which the president spoke even more frankly about Taiwan and Europe's strategic autonomy were cut out by the elites. So, you know, you have our allies, one of our biggest allies, that is candidly, although they don't want the West to know about it, speaking about their disdain for the sanctions and choosing sides and getting involved with Taiwan. They say we can't do anything about the Ukraine as it is. Now we're fighting with our relations with Japan, or with France, you could argue, are shaky. You could argue our relations with Germany are shaky because of what's going on with the energy and the pipeline. Look what's happening in Mexico. I mean, this administration is really destroying our credibility. And is that by design? I don't know. But what it is doing is it is incentivizing even people on our side to choose sides and not our side anymore. And I think it's really very, very important when people think about the macro in all of this, what everything means. It was one thing when we were talking about Saudi Arabia and the rest of the BRICS countries and the Belt Road Initiative, which now has way over 150 countries on it. But when you see Saudi Arabia join the Shanghai Cooperation Organization, which is military, when you see France exiting stage left, when you see Mexico joining the BRICS, when you see Japan, Australia, New Zealand rumored to join the BRICS, when you see Brazil say we're going to sell only in yuan to China, when you see all of these deals being made, when you see Iran and Saudi Arabia mending fences, Sunni and Shiite, over hundreds of years worth of hatred, now doing this for the commonality, the common good against the West, people need to wake up. I mean, the acceleration of this is extraordinary. And then you see the idiotic moves we're making inside the country to blow up our regional banks and our commercial real estate and force everyone into a handful of commercial banks. It's a very frightening scenario. And you know, I think people really need to think about this because I think we're getting to that point where the rest of the world is getting fed up with our policies inside and outside the system, inside and outside our borders.
Well, we're coming up against the end of the hour. We've got a very active chat here, but it's great to see all the regulars and a lot of new faces, new names there as well. And Andy, as always, it's great to have you here in our corner and giving us not only just an insider from the precious metals industry with your depths of decades of experience there, but also your broader perspective that you've pulled together and delineated for us about what's really happening on these geopolitical, these macro.
Let me give you one
things.
more. I know you want, I know we got to go, but I want to give you one more. I want people to think outside the box. That's what I tried to do. I mean, I always try to think outside the box. So we're going to go 2 minutes past 10. I want you to think about this for a second, right? I don't know if I've talked about this with you. Maybe I have, maybe I haven't. But, you know, Lael Brainerd, I don't know how much we've talked about Lael Brainerd, but Lael Brainerd was originally at the Treasury and then went to the Fed. I think Janet Yellen was at the Fed, then the Treasury. Lael Brainerd was originally at the Treasury and then went to the Fed. And when Powell was being reappointed, I told everyone that I thought Lael Brainerd would win. And she was this up-and-comer. She's a modern monetary theorist. Her whole idea is to get rid of the commercial banks and deal directly with the public from the central bank. Whether it be giving you money, as she says, would stimulate the economy. And even though she says it would be controversial, take money away from the public if they needed to slow down the economy, put the brakes on, if you will. Now, here's where it gets a little interesting. I want people to think outside the box. I've talked at length about what could blow things up outside the border with the BRICS and the dumping of dollars and all of this stuff, the loss of the petro standard. Maybe their backup plan to the Great Reset is what's happening right now inside the borders. I just want people to think about this for a minute. So she was at the Treasury, then she goes to the Fed and she runs for Fed governor or Fed chairman, and she loses to Powell, who was reappointed by Biden, surprisingly as a original Trump appointee. And then she becomes vice chair at the Fed, second in charge. She just left the Fed and she is now heading up a economic advisory committee with the president at the White House. Treasury, Fed, White House. Her whole thesis is get rid of the banks and deal directly with the public through the central bank, modern monetary theory. So if that really was what they were trying to do, wouldn't the first step be to light a fuse under the 5,000 regional banks and freak everyone out enough to where $1 trillion has left the banking system in the last week and gone to the commercial banks into their money markets? That's just 1 week. The fragility of the regional banks is becoming something that this story is not over. We will talk a lot more about that over the coming weeks, but I could see a point where all of these regional banks fold and they end up being gobbled up by the large commercial banks. Mm-hmm. So let's just play this out a little further. Let's say that happens over the next year or two or less, and everyone is funneled into a handful of the commercial banks, right? What is Lael Brainerd's thesis? Modern monetary theory, get rid of the banks and bring out a central bank digital currency. Mm-hmm. Step one, blow up the regional banks, freak mm-hmm. everyone out, say we're not going to backstop them, only the too big to fail banks. Everyone goes into the commercial banks, and then what happens? JP Morgan has over $50 trillion in derivatives. All of these banks are tied together like in a bunch of knots. One goes bang, they all go. Blow up the commercial banks, and then everyone goes with it. In comes the CBDC and the new central bank digital currency, the reset. And I just want people to think that these are realities that we never talk about, we never think about. But either our leaders are completely stupid in the way that they make these decisions by saying some banks live, some banks die, which represents 70% of all the small business loans, 40% of US GDP, the small businesses, and the majority of all the commercial real estate loans. Or they are just completely oblivious to the consequences of their actions. But if Lael Brainerd really did have the ear of the Treasury, the Fed, and now the president, and that is the agenda to go to a central bank digital currency, mm-hmm. Step one, blow up the regional banks. Mm-hmm. Step two, put everyone into a handful of big commercial banks. Step three, blow up the commercial banks. And in comes the savior. We make everyone whole with the new central bank digital currency. Now, this is all supposition. I just want people to think this is how important it is to think outside the box right now and to think about protecting your wealth with something that's outside the system. And maybe this is why the central banks are doubling down on what was the second largest acquisition in history last year. The month over month increase between December and January by the central banks is 198% more in January than December. I don't know what the March numbers are yet, but the biggest money in the world is running, whether it be the central banks around the world, whether it be the people draining the metals exchanges or the people calling us. People are finally waking up to these consequences, these potential consequences. And I think it's time to think outside the box and to think differently than we normally did forever, where everything was somewhat in a linear fashion and was right in front of you. It's not anymore. And that's why it's time to own gold and silver.
Yep. One bank to rule them all, and never let a good crisis go to waste, even if you have to foment it yourself. So, all right, Andy, we've got to wrap. So thank you very much for being here. I can
talk with you all night, but I'll let you go.
Sorry, yep, we got to go. So thank you everyone for being here. You guys make it happen. Make sure you go to libertyandfinance.com, sign up for our free newsletter, libertyandfinance.com, your name, your email address, submit, confirm the email you're in, and you get a free email with all of our guests, including Andy, so you won't miss a single episode. Andy, thanks for being here on Liberty and Finance.
Good to see you, buddy.
Take care.